On this day, gold starts in a state of equilibrium before the London session, with price respecting the second VWAP standard deviation bands on both ends. This balance between buyers and sellers created a neutral environment, giving us little to work with initially. But then London opens and everything starts to shift. The first major clue, volatility begins to shrink. Instead of price moving between the outer edges of the second VWAP deviation bands, we see it tighten up, oscillating within the first bands. This contraction of volatility hinted at a potential buildup. And as we know, shrinking volatility often precedes an expansionary move. Here's where things get interesting. Price makes a weak push lower, stalling just below VWAP before reversing and moving higher. But even that move higher shows hesitation. It fails to reach the high of the day or the second upper VWAP band, rolling over and heading lower instead. Now comes the false sell-off. As price takes out the London session low, it tempts traders to go short, thinking the break signals continuation. But here's the thing, volatility had already shrunk. We knew to expect price to react at the first lower VWAP band, not the extremes of the second. The biggest giveaway though, the aggressive selling orders that poured in as the session low was breached. Let's break this down. The sell candle that took out the session low didn't seem climactic at first glance. It wasn't unusually large, but when we analyze it with more precision, the signs of exhaustion become clear. Stacked selling imbalances appeared, showing aggressive selling. On a 10-tick Renko chart, the selling volume concentration was off the charts, with a delta to volume ratio of 100% selling and no buying. Turning on the adaptive big trade indicator, we spot a massive sell order of 225 lots, one of the largest trade sizes in the last 5 days. This was classic climactic action, although very subtle on the surface. Now, if this sell-off represented smart money dumping positions, price should have continued to collapse, but it didn't. Instead, the next candle tells the real story. Ultra high buying volume steps in. This wasn't random retail activity. This was demand overpowering supply. The buyers weren't waiting for better prices. They were stepping in aggressively, becoming liquidity takers. But smart money doesn't stop there. They mark the price down once more to retest the low, looking to flush out any remaining sellers. This time, the volume on the test is nearly non-existent. A clear no supply signal. No sellers remain. And just like that, the reversal begins. After the low volume test of the lows, price forms a double bottom, and on the break of the neckline, stacked buy imbalances appear. Clear evidence of aggressive buyers stepping in, which was the first sign of strength after accumulation. Then, price pushes higher, breaking the high of the day and surging to the second upper VWAP deviation band, after which momentum slows and price consolidates sideways for the remainder of the session. This trade perfectly showcases the principles of the market trinity and the 7 key metrics working in harmony. From the shrinking volatility signaling a potential reversal to the climactic action flushing out sellers, every piece of the puzzle aligns. Notice how we use tools like the VWAP bands to gauge volatility and trend pulse, combined with insights from order flow analysis, such as stacked imbalances and Renko charts to confirm smart money's intentions. Without these metrics, we might have been fooled by the false sell-off or missed the low volume test of the lows. By aligning ourselves with the market trinity and deciphering smart money's blueprint, we position ourselves to trade with confidence. And with the buyers dominating, the path higher became clear. Now imagine applying these principles across different markets and timeframes. With this level of clarity, you're not just guessing where price might go, you're understanding why it's moving.